Welcome, everyone. We will start as others are joining. Welcome to our year-end tax planning webinar. My name is Beata Dragovic. I'm the founder of Freedom Trail Financial. We are a wealth management and financial planning firm here in Boston with clients across the US. And we work with retired clients, pre-retirees, and a lot of professionals with equity compensation grants. I am very excited to introduce our guest speaker, Richelle Maguire. Richelle, thank you for accepting our invitation, for being our guest speaker.
Thank you for having me.
Thank you. Richelle is a partner at DGC division at PKF O'Connor Davis, and I met her actually while you were on the board of the Boston Estate Planning Council. She's let me introduce her properly. She's a partner in the private client group there. She has over 20 years experience providing income, estate, and gift tax planning, consulting services, and tax compliance. Her clients include high net worth individuals, trust and estates, private foundations, and she works with a broad range of clients in a variety of industries. She also has experience working with non-traditional families, including same-sex and unmarried couples. She's an accredited estate planner, a graduate of Bentley University, a Bachelor of Science in Accountancy, and a Master of Science in Taxation. And she also holds a certificate in personal financial planning from Bentley University. Again, she has multiple professional associations. She's the member of the American Institute of Certified Public Accountants, Massachusetts Society of Certified Public Accountants. She was on the board, and she's still a member of the Boston Estate Planning Council, right, Richelle?
Mm-hmm.
Boston Foundation's Professional Advice Network, and she's also on the Finance Committee. She's a Finance Committee member with Adoptions with Love. So again, Richelle, thank you so much for accepting my invitation to do our year-end tax planning webinar this year. So this will be the flow. I will do a very brief 6-point year-end checklist for equity compensation mainly from the financial planning standpoint, even though we are talking about taxes today. And then Richelle will take over, talk about general tax planning. We'll talk again about stock option planning, charitable planning, retirement plan considerations, contribution limits, and we'll give you a year-end house cleaning list as well. We will take questions at the very end, so please feel free to send us any of your questions that you have, and Richelle will be happy to answer that. So let me just very briefly go through the year-end checklist that I believe is important on equity comp, and then we'll switch gears for general tax planning. So first of all, even as a financial planner, I can't help but immediately recommend that revisit your financial plans. Concentration and tax planning tax rate should never be the only reason why you exercise options or make decisions, sell shares, company shares. Your personal financial goals, investment objectives should be always your primary driver for that. Multi-year planning is very much recommended for your equity grants, given the spikes of income that can occur when you exercise options. What I recommend, or when RSUs and restricted stock vests, with year-end planning, beginning of the year planning, what I always recommend that you review vesting schedules for the new year as it comes to RSU stock options. And again, as a financial planner, what I come across with what I want to mention here is that it amazes me how many people don't know what kind of options they are receiving, whether that's non-qualified stock options, incentive stock options. They have very different tax treatments. Also, Richelle might talk about this part as well, but I see very rarely that people realize when they are granted restricted stock, when the market is down as it is right now, restricted stock allows you to file an 83B election with the IRS, and you can pay for taxes. You can pay taxes at grant versus at vesting. So that could be a good strategy potentially for you to do in the new year. Again, with the down market, tax loss harvesting has been very popular in your non-qualified portfolios, and I see a lot of clients wanting to do that with company stock as well. You want to watch out for the wash sale rule. Again, when you buy back shares, you have to wait 30 days before and after in order for you to be able to take the losses on your taxes. This is the time when many of you know that you are changing jobs in the new year. So this is a important planning time, financial planning time for your equity comp. And even if you are by any chance not receiving equity comp, you review your compensation. This is the time you review this year your performance shares, RSUs that vested. If you are planning to leave, you want to look at potential salary, sign-on bonus, estimate that for the new year and this year, potentially how many non-qualified, how many options you will have to exercise. You will have 90 days once you leave to exercise options. So when you answer all of those questions, it's easy to answer also, should you accelerate income into 2022? And don't ever make these decisions alone. Ask Richelle or an accountant or your financial advisor. I know Richelle will talk about donating company stock or charitable contributions as well. I do want to mention here very briefly, this is a good time, also year-end, to review that for all of you with charitable intentions. I see this a lot. And again, one factor that I would want to mention here is that I see clients who are getting vested, who are being vested RSUs, wanting to donate that to charity. You do have to wait a year in order for you to be able to write off the full value of the market value of that grant. So make sure that you wait a year with that. And again, if you have family members with lower income tax brackets, this is a good time to gift company stock, especially if you are bullish on your company stock. Year-end tax planning, will very briefly touch base on this, and I will hand it over to Richelle because she will talk about ISOs as well and stock options. So unlike non-qualified stock options, ISOs we really recommend obviously holding for long-term capital gain treatment. This can be an idea, and I know we were talking about this as well. This can be a year-end strategy, especially in a bear market, that you can potentially sell whatever you exercised earlier this year, ISOs, you can sell now, create a disqualified disposition. Richelle will explain what that is. And potentially you can also, because your ordinary income tax rate is higher, you are able to actually exercise more ISOs, which we've done with many clients and without triggering EMT in the year end. So briefly, those are the main planning ideas that we see, and I'm going to hand it over to Richelle.
Thank you so much, Beata, and thank you for inviting me to be a speaker today and join you in this webinar. I think that what I would like to accomplish today is just to share kind of what we're seeing with our clients as we're having year-end planning discussions, and a lot of it is gonna replicate what Beata just shared in her checklist. So the most important thing is just to understand your baseline and where you're starting at. So I provided this first slide just as a reference point to understand what different tax rates might apply to your individual situation. And these may come into play at certain thresholds, like the net investment income tax or the additional Medicare tax on wages over $250,000, whether or not you're subject to the alternative minimum tax or you're self-employed. And the one thing I always like to call out on this slide is the Massachusetts short-term capital gains tax, because people are often very surprised to find out that that is, although the regular tax rate is 5%, the short-term capital gains rate is actually 12%. So we always are looking to avoid that wherever we can from a planning perspective. So next slide, Beata, thank you. So from a planning considerations, capital gains and losses are always a primary focus when we're doing year-end planning. It is the one thing that will fluctuate the most from year to year in a client situation. We try to work very collaboratively with the investment advisors of our clients to make sure that if there are capital loss carry forwards on the table from prior years, that the advisors are aware of that, so that when they're looking at the portfolio and seeing opportunities, they know what they have available to potentially offset any gains that are realized. Excuse me, as Beata mentioned, loss harvesting, oftentimes it's in a year where we have realized gains year to date, and we're looking to offset those with some potential losses that are available in the portfolio. In the market that we've been working with, we're finding that a lot of clients are in a year-to-date loss position already. So we actually have some kind of reverse planning happening with the passing of the MA Millionaire's tax, and knowing that tax rates are going to be increased for certain taxpayers in subsequent years. We're actually looking at not just potentially realizing gains to utilize those losses and potentially reset basis even if you just immediately reinvest. But also looking at potentially realizing gains and paying some additional taxes this year, because it may be beneficial looking at it from a long, multi-year perspective to take that hit this year, pay the tax to avoid the additional surtax in the subsequent years. Always want to look through your portfolios for any worthless investments, but this is a very area that you want to approach with caution. It is often sometimes a bit subjective because we don't have the documentation. So when we're working with clients, it's not enough that the company has filed for bankruptcy. It really has to be that you have, the law basically says that you have completely abandoned your position. And that can be difficult if it's a publicly traded security and it's held in a brokerage account. It's very hard to get that security taken out of that account, even if it's at a zero value. So, oftentimes we're looking at, whatever documentation has been received regarding bankruptcy proceedings, who the end all beneficiaries will be in those proceedings, and making sure that we have padded the file with sufficient documentation to take a position when dealing with a worthless investment. And oftentimes we're dealing with that in a private equity situation where it's not that it's listed on a stock exchange, it's not listed on a brokerage account. So we can make an argument and make sure we have the documentation available in case that position ever comes into question. For more significant sales of companies, we're certainly looking at installment sale treatment to defer some of the gain to subsequent years. For federal purposes, you have to be careful. State laws can be very different. Massachusetts law is different than federal and requires some additional steps if you're going to. We actually have to apply and elect into installment sale treatment. So, and depending on the dollar thresholds, there may be some bond to post as well for the deferral. So you need to be aware of that and take that into consideration. From a netting perspective, we always just remind people that, from when determining your ultimate net gain or loss, you're netting short-term gains with short-term losses, long-term gains with long-term losses, and then netting the two. And so when you're taking a short-term gain and you're using a long-term loss, you may not be getting the best tax benefit. So kind of looking into those details as well to see if there's any opportunities to get a better tax result. Qualified opportunity zones came into play a couple of years ago. Basically gives you the opportunity to roll or reinvest proceeds from a sale and defer gain to subsequent years. But there are specific qualifications for the reinvestment. There are specific holding periods that are required. So we've seen this come into play a bit, but not nearly as much as we originally expected. Next slide. Stock option planning. This is an area that has certainly had a resurgence in the past few years. And as Beata mentioned, and the number of times I get a call from someone that says they have options, and I ask what type of options, and they have no idea. So, it is important to know what type of options or restricted stock awards you have. Review your vesting schedules so that you know what is available today versus what's coming down the pike. And as Beata mentioned too, like reviewing prior option transactions. So, with the market decline, we have a lot of clients that exercised either near year end last year or the beginning of this year, and the price has now declined. And so we are looking at, rather than taking that adjustment at that fair market value at time of exercise, disqualifying that transaction. So basically selling the stock before the 12 months has lapsed, picking that income up at the current price as ordinary income, and hopefully offsetting that with some other opportunities with their options. So it's very important on the options, as I said, to know what you have, what's on the table, and also to know what's your end goal. So some clients that I work with have a dollar amount in mind that is like their target. Other clients have a time horizon in mind. I have clients that say, I don't plan on being at this company beyond the end of next year, so I want to take full advantage of what's on the table. We may have clients that have left a position and only have 90 days to act on what they have available. So it's really important to be aware of what you have and what the implications are. You know, for non-qualified options, generally speaking, you want to exercise high, and you're generally going to be exercising and selling because that income is going to be includable in your compensation at the time of exercise. So you don't want to run the market risk of that stock going down when you have already picked up the income and paying the tax on it and have no way to reverse that.
Richelle, do you ever recommend keeping non-qualified options for any reason?
I have had a few clients do it. It makes me incredibly nervous. But it is, ultimately comes down to your gut on the stock, but it is a very risky proposition. And oftentimes looking at the bigger portfolio of the grants that are available, we can kind of marry that and look more to the ISOs for the long term and let the non-quals be the cash out and, take that risk off the table. Because you also have to look at this from a diversification perspective.
Agreed.
I've had clients, sadly that, were worth millions on a sheet of paper. And, you have to remind them that that's only on that sheet of paper on the price that it is today. And it doesn't mean anything until the money's in the bank and the taxes are paid. So, it is a very, it is a difficult area to plan because as the market fluctuates and the results can change dramatically. But, when we're looking at our doing planning with our clients, we're kind of looking at, different scenarios and kind of laying it out based on the current price and saying, this is the most ideal. And this accomplishes, both diversification and maximizing the tax benefits without incurring an astronomical tax burden at the end of the day.
Thank you. Yeah. Moving on, right?
Yes, I think we can move on from there. So charitable planning is always I won't say always a component. This is very personal. We have clients that want to give away the maximum that they can from a deduction perspective every year. We have clients that give away more than that and carry forward the excess. We have clients that just do nominal contributions. So, it really is specific to an individual. What is their philanthropic desires? What are their philanthropic goals? And also, how much can they afford? Because I can tell a client what to give away to save taxes, but if they're not willing to part with that cash or they can't afford to part with that cash, it's really a moot point. And with the changes in the tax laws in recent years and the increase in the standard deduction amounts, we're finding a lot of clients that are not getting the benefit from their charitable contributions. So if you are not itemizing your deductions and you're just taking the standard deduction, the current law does allow a small above the line deduction of, it was $600 last year for COVID. It's $300 for this year, but it's not much. And so for clients that are looking to do a little bit more giving, but are just shy of beating that standard deduction amount with their itemized deductions, we are looking at things like bunching strategies where you might alternate the years that you do your charitable giving so that you're giving twice as much in a year and utilizing the itemized deduction and getting the benefit, and then defaulting back to the standard deduction in the alternate year. We work with a lot of retired clients. There's an opportunity for you to meet your required minimum distribution through qualified charitable distributions. There is a limit of $100,000 a year. And so the benefit of that is that the contribution goes directly to charity. It satisfies your required minimum distribution amount for the year up to that limit. And so you do not, as an individual, you do not pick up the income from that distribution. You're not going to get a corresponding deduction because you're not picking up the income, but it helps with other aspects of your tax picture because thresholds for other taxes are based on your adjusted gross income. So as that goes up, other tax benefits go down. So if we keep that adjusted gross income level from escalating, you could benefit in other areas. And there are some situations where we've run productions and we've said it's actually better for you to take the cash and make a gift versus doing the gift from the directly from the IRA. Use of donor advised funds and or private foundations. So if the client has a significant transaction and is looking to do a more significant gift, or in consideration of bunching strategies as well, a client may say, I don't want to give all of that away in 1 year, but you could use a donor advised fund. You get the donation deduction when you fund the account, but you can divvy that out over a variety of years. So you get the benefit of the deduction up front, and you can use it over corresponding years. Private foundations, really, we only really advise them. It used to be $1 million limit. It's really getting up to more of like a $5 million limit. So unless you're looking into that level of contribution, there's really not a lot of benefit to doing private foundation. It comes with a lot of regulation. There's annual tax filing requirements, and penalties can be severe. So unless there is a real family drive to create a legacy and have members serve on the board, you can accomplish pretty much everything that you do with a private foundation these days with a donor advised fund. And it used to be that donor advised funds, you were more limited in investment options. You used to not be able to name the fund, and all of that has changed. So a donor advised fund has really become, the replacement to the traditional private family foundation. Whenever we're looking at maximizing contributions, giving appreciated security directly to charity is a huge benefit, because not only do you get the deduction for the fair market value of the security at the time of the gift, but you also avoid the tax on any appreciated unrealized gain on that position. So there are limitations. So when you're giving cash away to a public charity, you can give up to 60% of your adjusted gross income. When you're giving stock, you're limited to 30%. So we're often looking at what is the maximum you want to give away. Let's start there. And then what's the best way to do that? And are there positions in the portfolio that we can utilize to fund that gift, and then supplement with cash as needed? Always want to make sure when you're giving, public traded securities are easy because they're readily market values accessible. But if you're giving things like real estate or art or antiques or collectibles, you want to make sure that you spend the money and get a qualified appraisal done. Any property in excess of $5,000, it's a requirement, and it does have to be attached to the return. The appraiser will sign off on the appraisal, and when you're over $5,000, we also need to get an acknowledgement from the recipient organization that they have received the item, acknowledge its value, and that gets attached to the tax return as well. And even for your smaller contributions, make sure you get a good receipt. Any gift being made is supposed to provide an acknowledgement if it's over $250. Keep those in your files. We don't, as a tax preparer, we don't collect those in our records, but we advise our clients, hold on to those, keep them in your tax records, because if the IRS does come in and audit you, we want to make sure we have all that documentation on file. We're not going to want to track it down 3 years later. Next slide, thanks. So retirement plan considerations. So always want to make sure that our clients are taking advantage of their employer-sponsored plans, making sure that they are considering their options there, whether they have a traditional and or a Roth option, and which one makes sense. Make sure they're maximizing to get any match that might be available. For our individual clients that are self-employed, we're certainly looking at opportunities to do individual retirement plans for those clients, and working with them to determine what the right amount is. So some clients will do the maximum amount every year. Other clients, we're running the numbers to say, if we do X, you're going to save Y. And we come to a determination somewhere in between. IRA contributions, whether, if you're sponsored by an employer plan, you're not eligible to make a deductible IRA contribution, but you're still eligible to make a non-deductible IRA contribution. So it's another opportunity to increase your retirement savings, even though there's no tax benefit at the funding. A lot of questions come up with children that have earned income, summer jobs, and whether or not they can fund an IRA. And the answer is absolutely yes. You just have to have earned income to make a contribution to an IRA. So whether little Johnny made $5,000 at his summer job, he can do $5,000. If he made 10, he's going to be subject to the limits that are imposed by the IRS. But, definitely looking at those opportunities, which there's certainly the children are probably not thinking of, but the parents should be thinking of. Roth options and possible conversions. We are looking at this significantly, especially with the down market and the portfolio values being down. Great opportunity to maybe convert some of those funds to Roth and pay the tax now at potentially lower tax rates than may be imposed at the time of distribution, either to you or to your beneficiaries. I'll just mention here that the rules of inherited IRAs changed a few years ago. And so it used to be that an inherited beneficiary could continue to spread those distributions out over a stream of years or their lifetime. But the rules have changed that now it has to be taken out within 10 years. So that can cause a significant hit and push that beneficiary up into a very high tax rate and eat into that inheritance. So by converting today at a lower rate, those funds can continue to appreciate through the years. And then when a Roth distribution is taken, it's taken tax-free.
Yes. And so I was just going to ask when I was saying this, that do you recommend for the new stretch IRA rules, what to do with them? So one of them you recommend is that they potentially, if it makes sense, convert to Roth. If they are not able to convert to Roth, you usually recommend spreading it out.
So the 10-year rule is fixed regardless of who inherits it, except for the only exclusion is a surviving spouse.
Yeah.
So we are definitely looking at with our clients, again, looking at their base projections. And if there is a IRA component in their portfolio, looking at, okay, what tax rate are you in and what could we utilize? What space do we have before you get to the next tax rate? And then, looking at both from that perspective and then from a much longer term perspective, what rate do you anticipate being in your retirement? And or what rate do you anticipate your children being in? Because if the children are high income earners already, they're likely already going to be in a high tax rate upon inheritance. And so the Roth option would make sense. And it doesn't have to be done all or nothing. It can be done in pieces. And so a lot of clients were doing $100,000 this year, $200,000 next year, and just chipping away at it each year. So it's not a one-shot deal.
Yep.
And of course, making sure that you're aware and taking your required minimum distributions from your IRAs and your 401ks and factoring those into your projections.
Yep.
So this is just a summary of the contribution limits for 2022. All of these are adjusted annually for inflation. So, currently traditional and Roth IRAs, the limit is $6,000 with $1,000 catch up. If you're over 50 years old, that will increase next year to $6,500 with still a $1,000 catch up. 401ks, 403bs, your max currently is $20,500 with a $6,500 catch up of over 50. Next year, that will go up to $22,500 with a $7,500 catch up. So again, these increase incrementally each year. Simple plan, $14,000 this year, increasing to $15,500 next year. $3,000 catch up this year, $3,500 next year. SEP IRA for a self-employed individual is limited to 25% of compensation or $61,000 maximum. So again, that will increase again next year to $66,000. So a lot of benefit there, a lot of opportunity. And the 47B plans under government, 2025, similar to the 401ks currently, that will increase similarly to 22.5, similar to the 401ks next year. And catch-up contributions are only permitted if it's allowed in the plan document. Next slide. So general housekeeping that we, just like changing the batteries in your smoke detector on New Year's Day, always advising our clients to review their plan documents for their estate plan. Laws have changed pretty dramatically through the years, and making sure that even you're aware of, who you named as your personal representative and whether or not that still makes sense. Who did you name as guardian for your children? Because that your feelings may have changed. Similarly, your healthcare proxy, who do you trust to keep you plugged in or pull the plug if the time is needed. So, and making sure that beneficiary designations are up to date, that the horror stories of, never changing your ex-spouse off of your IRA or whatever it may be, all these things are not set it and forget it. They need to be reviewed, take an inventory. I like to do a net worth statement with my clients, review it on an annual basis, do a summary of their estate plan so that, they understand what it means and what it does and what would happen if something, God forbid, happened. Make sure that you're retaining all your appropriate documentation. 7 years is the rule of thumb for tax records, unless, but there may be pieces of your prior records that we may want to retain as well. So we have those conversations quite often with clients. Consider reviewing your insurance coverages, whether it's your life insurance, your property casualty insurance. Again, those are not just set it, forget it, and pay the renewal. And consider any upcoming life events, whether it's, a marriage, a divorce, a birth of a child, a child reaching majority, or, a potential inheritance that's coming down the road, and make sure that you're kind of keeping that in mind in your planning and in your considerations. So next slide. So hopefully, tax planning can certainly provide significant savings, but it's not easy. And, many of my clients wish that I could give them a little calculator that they could plug in some information and it would magically tell them the results. But especially when you're dealing with, stock option planning, it is complicated. And, the difference between regular tax computations and alternative tax computations is complicated. And it's not just a plug in a few numbers and be done with it. So, really important to seek advice, make sure you understand what you have, make sure you understand kind of a path to achieve your goals, and, plan early, plan often, and be prepared. So, in my conversations with clients, we're not just talking about today, we're talking about next year, we're talking about tax law changes coming down the pike, and, when our current law is sunset in 2025, and we revert back to the old provisions back in 2017, so, keeping these things all in mind as things change and as new proposals come up for consideration.
Yes. Thank you, Richelle. That was excellent. Thank you so much for that. And I do want to mention that I have a few questions here for you. Really appreciate that. One of them is about, actually, that's something you mentioned earlier, and that is about the Massachusetts millionaire tax that just got passed. So the question is, what are you seeing with regards to the Massachusetts millionaire tax?
Yeah, sure. There's still a lot of ambiguity in the law. The law was not written very well, so we're still not unclear whether this is going to be applied to individuals and trusts or only individuals. We are seeing a lot, as we have seen through the past few years with COVID. We've had a lot of clients coming to us with questions about changing their residency, and that conversation the phone's been ringing off the hook since the law was passed, and what it means to change your residency, what has to be done, what hoops do you have to jump through, what documentation do you have to have. We have to believe that there will be an increase in residency audits as a result of a potential, mass exodus from Mass, both from a business perspective and an individual perspective. Trusts, in a lot of cases, we've been moving them out of Mass to better tax states anyway. So that has been kind of a transition that's been happening already. And we're also, as I mentioned, just doing a lot of reverse planning right now. I had a client yesterday talking about changing their year end because of a significant transaction that happened in 2020 to make sure that it's not going to be imposed by the Mass Millionaires tax. We have clients, where possible, potentially changing their closing date on the sale of their house if they can. Sometimes things like that don't have a lot of flexibility. Or the sale of your business, if there's an opportunity instead of on January 3rd to do it on December 28th, that can make a big difference.
Yes.
And as I mentioned, just, clients that are potentially realizing gains now and resetting their basis to avoid that surtax on whatever realized gains they're currently sitting on.
Yes, thank you.
There's a lot of activity.
Yes. So here is a comment actually just came in that actually not even a question, that whether there will be there's a lot of good information here, Richelle, what you said, and whether there will be a recording. And yes, we will send out recording. So you are able to review this. And there's another question here that more relates to stock options. And the question is, what would you recommend watching out for if I work for a private company and want to exercise options?
Yeah, so private companies are a little bit different than public because of the valuation issue. And so oftentimes you're waiting, when you're receiving stock rewards from a private company, they're providing you with the valuation at that time. And as you mentioned, Beata, earlier, we do need to file an 83B election in order to start the clock ticking. So when you file an 83B election, you recognize either the value of the stock in its entirety if you didn't have to pay for it, or the differential between the value of the stock and what you had to pay to acquire the stock. And we want to get that 83B election filed with the IRS and as well as attached to your tax return to report that election, set the clock ticking on the holding period of that stock, so that once you get to 12 months of holding period, you have the opportunity to then sell that stock at long-term capital gains treatment, and or as you mentioned earlier, utilize that potentially for charitable giving.
Yes. Thank you, Richelle. And as that comment just stated, it was an excellent job, very, very great job summarizing all of that in 30 minutes. Thank you so much. So if either of you would like to, anyone wants to reach out to Richelle, her email address is right in front of you, but at the same time, I'm also able to connect her with just about everyone. And Richelle, thank you so much again. I believe there are no more questions, no? Thank you so much for accepting my invite again and for this great information today. And thank you everyone for being here. Happy holidays to everyone. And please reach out with any questions. Bye, everyone.
Thank you so much.
Thank you.